Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times bestselling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. I am joined today by Emilie Hill, who is a principal at ZWJ Investment Counsel and a CFA charter holder who has dedicated her life to promoting financial wellness. She's here today to discuss everything from the current market environment to achieving the all-elusive financial wellness, as well as to break down the specific needs of women when it comes to investing and personal finance. Emilie, welcome to the show.
Hi, thank you so much for having me.
Yeah, my pleasure. It's been a long time coming. So we have to, full disclosure up front, we are friends. And so we were talking the other day about one of our favorite things to commiserate about. I think just about every time we talk, we have some sort of gripe fest about, wow, the market is so crazy right now. And I loved what you said the other day. You said, Daniel, you know what? I don't know that there's ever been a time in my life or anyone's life that the market wasn't crazy. So did you decide you were right? Is the market always crazy?
This is true. I started my career in 2014, and I can look back at every single year since then and identify how I thought the market was crazy in that given year, every single year since 2014. And, another reason is because I read a lot of history. And so just looking at historical examples, when certain things happen in the market, it just has me feeling very uneasy. I think what it boils down to is, and you can back me up on this, humans hate uncertainty. Mm-hmm. And the market is uncertainty distilled. It's like where you go for ultimate uncertainty. So I think this is why we have such a hard time with it. And yeah, I think it's just, one has to acknowledge this is just going to be a fact of being in the market.
So I want to take the market is uncertainty distilled and put it on a t-shirt and a coffee because I think that's really great. And this is one of those, I think, simple but powerful things to just recognize and own about our own behavior and our own tendency. I mean, you and I, we know what we're doing, and yet we still have these conversations and we still get hesitant and all of these things. A couple of recommendations here. One is a blog post written by Michael Batnick called "There's Always a Reason to Sell," which I think is fantastic. The blog post itself is excellent, but I think the best part of the post is actually a visual. So he lays out a timeline and puts, at every 6 month, 1 year increment, really legitimate reasons why you might have wanted to sell. And none of them are sort of trumped up. They're all very legitimate, in some cases, earth-shaking reasons to sell. Warren Buffett also has a quote, he talks about the 20th century. And I mean, the 20th century was a nightmare, right? I mean, we had multiple huge financial crises. We had a couple of world wars. We had a bunch of wars on top of that. We had pandemics. And yet, if you look at the 20th century, this very turbulent, very bloody time in human history, the markets did very well. And then finally, in the spirit of self-promotion, I've got to give a shout out to my own blog post. I wrote a post that I had apparently forgotten about since I was whining about how crazy the market was. And the blog post is called...
Yeah, I looked it up. It was from 2 years ago.
Right. Yeah. I'm guilty of not taking my own advice, certainly. But the name of the post is "There's Never a Good Time to Invest." And I just want to read a quick passage from that. It says, "Because of the asymmetrical means by which we evaluate risk, it could be truthfully and plainly said that there is never a good time to invest or have a baby or start a business or fall in love. After all, each of these requires us to make ourselves vulnerable, either personally, financially, or both, to an unknown future with a very real downside. Markets crash, kids talk back, and businesses fail. But a life lived in shades of gray is the only thing less satisfactory than a life lived at risk of loss. There will always be worries, some founded, others not. And investors who are paying attention will never have a sense that it's all clear. This uncertainty, this pervasive not knowing, is the hallmark of both life and capital markets. And those that have mastered both come to love and embrace it. So there it is, from my own words being used against me from my post. There's never a good time to invest.
I absolutely love that. I think something we need to say is that the opportunity exists in the uncertainty. I recently listened to Warren Buffett's biography, The Snowball, which was like 70 hours long because it like spans the stock market. Learned a lot of history, but that is what he participated in throughout the 20th century. As he says, that was not an easy century, but that's where the opportunity was. If there was no uncertainty, would there be opportunity? I don't think so.
One of the things I discovered when I was a therapist, I think is entirely consistent with what you just said and the thing we're putting on our coffee mug here. And what I found with my clients when I was working in a therapeutic context is that some of the unhappiest people in the world were those who were holding out for certainty, or they were not taking a risk, right? They were not switching jobs. They were not being vulnerable to a romantic partner, whatever, because they're like, yeah, I might get hurt, or the business might fail, or, whatever sort of negative eventuality. But what was fascinating to me, that was these folks, in their efforts to try and avoid pain and heartache, actually brought pain and heartache upon themselves. And I think it's true in markets too, right? We want to avoid losses. We want to avoid uncertainty. So we sit on the sidelines, we sit in cash, we don't participate, which is one of the surest ways to bring about financial ruin, is to not invest in a way that keeps up with inflation. So there's a truth that you can bring a lot of misery upon yourself while trying to avoid misery and uncertainty.
I can share a personal side of that, if that's okay.
Please, yeah.
In 2020, I did two very uncertain things. One is just my career, an investment manager. That is uncertain. You never know what the market's going to do. I also had a baby in 2020, and my maternity leave ended right around March 23rd, which, if you recall, was the bottom of the market. So that was a really interesting time to go back to work. And at that point in time, there was no childcare. So my husband and I were both working from home with an infant in a very uncertain period, not just with the markets and me and my day job, but in life. What is this pandemic? How is it going to affect us? And I actually started therapy during that time because I was not in a good place. And that is a huge thing that me and my therapist worked through and kind of laughed about. Is I'm a type A person. I like everything being very organized. I like knowing what's going to happen. And I chose a career where you can never know what's going to happen. So we got a good laugh out of that. But that has really been a journey for me over the past 18 months, is accepting the uncertainty just as a human. And that has completely informed and I think helped me as an investment manager.
Well, thank you for sharing. I think you bring up a great point, and something that I don't know that I've recommended pointedly enough on this podcast. My listeners who work in finance, right? Whether you're an asset manager, whether you're a financial advisor, as you just correctly noted, this is a career path that comes with an enormous amount of uncertainty. Now, add upon that you get sort of the secondary stress of having to be a buffer between your client's uncertainty and a bad decision, right? You're the person that they call and yell at when the market goes down. You're the one that has to be that wall between them and a behavioral error. When I was doing therapy, when I was, a therapist myself, one of the things that they required of us is that we always go to therapy ourselves. Like we always be in our own therapy because there's sort of a secondary traumatization that comes when 40 hours a week, much like a financial advisor, you're sitting across the desk from someone who's having a hard time. So I think that financial professionals, between the ways in which we're called on to be counselors and then just the level of uncertainty inherent in markets generally, I think it's a wonderful idea to do what you've done, which is to go seek out therapy.
I couldn't agree more with that recommendation for financial advisors.
Yeah, so let's get practical. I think we've decided that the market's always crazy, right? There's always going to be a reason to fear. There's always going to be a reason not to invest. So how practically do we sort of learn to feel that fear or recognize that fear, but do the right thing, do it anyway?
That's a really good question. For me, it's about taking a step back and looking at the long term, not to get too philosophical or feely, but really, if you're an investor, you believe in humanity, you believe in human ingenuity. And so in the darkest days in the market, on the days that are very uncertain, that's what keeps me going as a professional investor, is this belief that we as humans do have a gift to problem solve, and that's what we're going to do. And as such, I want to participate in that by being invested for the long term.
I think we need that philosophical bent sometimes. I think we can get so wrapped up in the minutia and the daily, ticks up and ticks down of the market that we sometimes forget at sort of the highest level. Being a long-term investor is a vote for human potential, right? It's a vote for human goodness and human ingenuity. And that is a vote I'll take all day. I'll make that bet all day long, right? That 30 years from now, we will be wiser, smarter, more ethical, more gracious, more whatever, right? I think that human history arcs towards greater development and even greater, sort of greater morality. I'll take that bet all day long. And that's something I think we need to remind ourselves of periodically. I think that's a great way to zoom out. So, let's talk a little bit now. You are an active investor. Now, this is something that is not as popular as it once was. When we look at fund flows over the last 30 or so years, we see that fund flows have gone passive at about a 3-to-1 clip. Given where we are today, right? Why do you think that running the sort of concentrated active portfolios that you do makes some sense for some subset of the population?
I want to think about this from a 30,000 foot perspective. I worry, let me take a step back. And this kind of relates to your previous question about doing it anyway in the face of uncertainty. And for me, that will always be a matter of going back to fundamentals, the things that we can measure, what we can know about companies and organizations and the economy. So then moving to passive, I wonder, I don't know the answer, but I just wonder if as increasing amounts of assets under management are passively indexed, and now that has eclipsed active management, what does that do to the creative destruction process in the economy, where inefficient organizations are pushed out and efficient ones survive, and then capital is efficiently allocated to do that? And what does that do to marginal returns? And so I think it's been really hard for active managers in the past decade for a lot of reasons. One of them being the low interest rate environment and then passive investing. It's sort of like all boats have been lifted. But now that we're past the point of, critical mass or whatever you want to call it for passive investing, I do think there's an incredibly huge opportunity for active investing based on fundamentals. Again, going back to uncertainty breeds opportunity. So in an uncertain world, which the world will always be uncertain, and when the majority of assets are passively indexed, in a way that kind of opens up the field for active management to really, have their pick.
What do you think it will take for active to sort of come back in favor? Do you think it's the next big sort of dislocation? Is it a change in Fed policy? Is it a change in market environments? What do you think is the catalyst that swings the pendulum a bit the other way, I guess?
So I want to state first, these are my opinions and not reflective of my firm. These are my opinions only.
Sure.
I think it will be a change in Fed policy and more sustained higher interest rates, which we could see because of more sustained inflation that we have right now, that is proving not to be as transitory. Who knows what's going to happen with that? But I believe we're at a point in history where inflation rates and therefore Fed policy and any central bank policy is going to have huge impact on the market. I believe that any change, which at this point the Fed has indicated the only change they can make is to go up, that I believe that will be the opportunity for active management. There's this chart that overlays the Russell 2000 index as a percent of how many non-earners are in the index. And you can overlay that chart to Fed rates. And when Fed rates are zero, non-earners go up because it lifts all boats. Everybody wins when there's no cost of money. So what happens when rates go up and non-earners are forced out of the market? To me, that is what will cause the change. And I will just add, perhaps that will never come because of modern monetary theory. And, there's a lot of people out there that are supporters of that theory. So, maybe it's just wishful thinking as an active manager.
Yeah, time will tell. I had a friend, I think those of us who work in finance, we have friends who are sending us things. I had a friend send me, questions about the market the other day and sent me some sort of histrionic YouTube video that he had found on Reddit saying that effectively the Fed was out of bullets. Sort of cautioned my friend, people have been saying that for, many years now. And so time will tell, but it's certainly an interesting hypothesis. I want to build on something that you mentioned earlier, this process of creative destruction. So if we look sort of philosophically at the virtues of active management, it would be things from a philosophical level, things like price discovery. Setting accurate prices for market participants requires some level of activity. Fraud discovery, right? Unearthing unethical companies or fraudulent companies are part of, again, that active process, and short selling, right? So it strikes me that there's a bit of a tragedy of the commons problem here, right? So the tragedy of the commons, my sort of a great example is, let's say there's some communal land in the middle of our town, right? Some communal pasture, and we're all farmers. It is in every farmer's best interest to go graze their sheep like crazy on that communal land, like go sheep, eat as much as you can. But if everyone does that, then there's no grass left and it fails, the entire system fails, right? So it strikes me that on average, the best thing for any individual investor to do is to be a passive investor. I mean, there's a ton of upside to this, and we've seen that over the long term. But the market requires some level of activity to function and to sort of avoid this tragedy of the commons. So how do we think about this? I mean, is it a righteous, virtuous thing to be an active investor, or how do you think about this from the creative destruction angle?
I wouldn't say it's a righteous, virtuous thing to be an active investor, but I do think active investors are necessary part of the ecosystem. I'm thinking of passive and creative destruction as sort of a catch-22, and I haven't done a ton of research on it, but it's just sort of my hunch, which is, the more passive there is, the less creative destruction there is. And then the less creative destruction there is, then there's diminishing margins of return for passive. And so then it's just this cycle. And then the question is everybody just okay with these lower returns in the future? I think there will always be individuals who require active management for various reasons. And I think those investors are a very important part of the ecosystem. Of course, passive is great for many people. I don't want to discount passive. We know how behavior gets in the way of people making the right investment decisions. So passive is an amazing vehicle for many people. But I truly believe active needs to be a part of the ecosystem.
Yeah, I agree. And, I think my own investing reflects that. I have a good proportion of my money in passive vehicles. And then with another portion of it, I try and, exploit some of the inefficiencies that you talk about. So trying to do my part in a small way to not eat all the grass. Let's talk about financial wellness for a moment. You have a fantastic Instagram account where you provide nearly daily tips about financial wellness. But the psychologist in me says that this concept of financial wellness hasn't been operationalized to my liking, right? Like it hasn't been concretized to my liking. It's everywhere. And yet it's nothing in some respects. What does it mean? What are the parameters? So the nerd in me wants you to talk about what are sort of the sub-facets of financial wellness. If we were to give that some form and structure, what would it look like?
So I thought a lot about this. I need to have a definition for financial wellness. And today my definition is, maybe it'll change tomorrow, but I really think financial wellness is integrating your financial health with your overall well-being as well as your value system. And the reason I got started down this path is because when I began my career, I quickly realized that my training prepared me for number crunching and for all kinds of quantitative analysis, but not for the emotional complexity of working with real money in the real world with real people. And then on a personal level, realizing my financial life is very siloed. And I see that with a lot of people. We tend to separate it and touch it with a 10-foot pole because in our society, it's impolite to talk about money. And so it's just kind of this topic that is the elephant in the room. And because of that, people aren't making optimal decisions. So I think integrating it with your overall wellness, the way you would go to a doctor checkup, like view your money the same way. It's part of your overall wellness. It has great impact on your wellness. It touches everything. So to pretend that it doesn't, I don't think that helps anybody out.
Yeah. Talk a minute, if you would, about the value system. I feel like that's sort of a unique addition you've got there. Why is it important that we integrate our value system into this overall financial wellness picture?
I think integrating how we are with our money with our value system is the most important thing you can do with your money. Mm-hmm. And that will be your North Star. It will also, talking about uncertainty, it helps just remove yourself from the emotional ups and downs because you have this North Star. There's a greater purpose to your money and to what it means in your life. I really believe that when you can integrate your money behavior with your value system, it creates this sense of abundance in your life. And by doing that, money no longer has the same control over you. It doesn't have the same impact in terms of stress, whether it's, financial stress because of debt or volatility in the market. I find it, for me personally, it's creating this sense of peace with money. And then when my mental state is at peace, I can make the most optimal decisions for myself with my money. So an example is gratitude. That's a very important value to me. And the way that plays out in my behavior is when I align my gratitude value with my behavior, the way that manifests is that I want to be a responsible steward with what I've been given in life. And so then that gives me a completely different perspective on my own financial planning, my own financial goals. So that's just an example of what I mean by integrating your financial wellness with your value system.
Heaven knows I have a lot of soapboxes I like to stand on, but my favorite of all time is that your why can teach you how, right? I think in every facet of life, if you prioritize purpose, if you prioritize values, so much else, so much of the noise gets filtered out, so much of the other stuff just becomes clear. And I think we as an industry are shifting in a direction where we're beginning to integrate values into the way that we invest, right? ESG, socially responsible investing, values-based investing remain very much in vogue. This is something we're all talking about. And I think that's a positive. I think that's a positive thing. But I think as you correctly point out, this should influence the ways in which we're charitable. This should influence the ways in which we spend our money. This should influence how much money we do spend, right? And save, and the compromises we make between sort of enjoying the day and securing tomorrow. The other thing that I would say, Michael Kitces and Carl Richards have a podcast that's really wonderful. And they were talking a while back on one of their shows about how vague most people's financial goals are, right? If you ask the average person, hey, what are your financial goals? It's something really nebulous, like don't eat cat food, or like have a bunch of money, or like have more than this jerk over here, right? Like it's these really ill-defined sort of nebulous goals. And I think that's the same way we are with our values sometimes, right? We want to be good people, we want to be happy, and a lot of times I don't think it gets much more concrete than that. So I think it's a powerful thing to sit down with your spouse, partner, therapist, financial advisor, whoever, and get very, very specific about what those values are for you, and then how they manifest in your financial life. So that's, I think, a powerful thing that people think they've figured out that they really haven't in a practical way.
Absolutely. That is something I was going to share, is that many of us on the spot cannot name our values. This struck me when I was at an organization on the board, and just as an exercise, we were asked to write down our 5 values that really shape our decisions and how we lead our life. And it was so hard. And I couldn't believe it. I was embarrassed. I was like, wait, I have values. Why can't I think of my values? So I have spent a lot of time thinking about that. And yeah, I think it's just a critical part of being human, is just to sit down and really think about what your values are, and write them down and put them somewhere that you see them. And they can change, it doesn't have to be static, but really think about it, because it'll be your North Star for everything.
The other thing that I find useful is sort of this exercise about figuring out the disconnect between your self-professed values and the way that you spend your time, right? Okay, so what are my top 5 values? I mean, I think for a lot of people, it's going to be stuff like time with family, spirituality, self-development, things like this. You go, okay, like how much time do you spend on really sort of perfecting yourself each week? And the answer is going to be vanishingly small, right? So sort of in a self-professed way, this is my number 2 value, but everything else gets in the way, right? Work and kids and every other thing gets in the way. So I think it's a powerful thing to define what, who you want to be versus who you are, sort of as evidenced by your calendar and trying to figure out the disconnect there. So this is great insights there. And I love you did the impossible. You took financial wellness and you made it workable. So congratulations. I wanted to ask you this next question because I think you sit in a very unique seat. So on the one hand, you work with very wealthy individuals as part of your job. And then on the other hand, you have this sort of populist, let's call it like this populist presence online.
I like that.
You like that? It seems that's like more demeaning a word than I wanted it to be. But no, you have this sort of retail presence as well, where you're out giving advice to mom and pop investors who wouldn't normally be able to work with a firm like yours. So one of the questions I'm asked commonly is about how sort of financial psychology differs at different levels of wealth. So you sit in this seat where you're able to see people at all different levels of wealth. I'm interested what you see with respect to how their behaviors differ, how their worries differ from one level of wealth to the next.
That's a really good question. And in my experience, I can honestly say there's no difference. I know a lot of research has been done on scarcity, and that's a real thing, poverty. When people are living in poverty and can't cover their basic needs, that creates a scarcity. It's real scarcity, but also a scarcity mindset. And then you make poor decisions because of the mental effects of scarcity. But after that, and you're right, in my experience, I work with high net worth individuals, but then on social media, I'm constantly having dialogue with everybody. Mm-hmm. I have no idea what their wealth is, but I imagine it spans a very broad spectrum. And I can honestly say everybody has the same concerns. And no matter how much money a person has, will their money last? They ask, will my money last? They're worried about this. What's going to happen to the market? Back to the uncertainty. Can I pay for my child's education and still retire on time? Mm-hmm. How can I give back? So I see the same concerns regardless of wealth level. And to me, that is so humanizing. Like that's just, we're all human. We are all in this together.
Mm-hmm. So let's talk about humanity. You are French. I wish I was French. And you and I are both big fans of French existentialism. And I've seen it inform how you talk about and think about money. So while we're on terms that everyone throws around and no one knows what they mean, what is existentialism and how does it sort of intersect with the way that you think about the financial good life?
Existentialism is very interesting. I think there is kind of has a bad reputation, like it's this really negative, dark thing, but it's really about searching for meaning. I think searching for meaning of life. What's our purpose here? Is there value to being alive? That kind of thing. But I really actually view it in an optimistic light. And I also want to add, I'm religious, I'm spiritual, and to me, they don't conflict. The way I think about existentialism as it relates to financial wellness is a big concept in existentialism is that we come into this world alone and we leave this world by ourselves. There are certain things in life that we will have to do by ourselves. And so applying that to financial wellness, we come into this world with nothing. We leave this world with nothing. And to me, having that perspective really creates space between me and the craziness out there, the crazy market, the stresses of the daily grind with money, like paying all these bills. And, it's a reminder that this is all impermanent in this physical world. So existentialism is the meaning, purpose, and value of human existence. To me, financial wellness applies that lens to our money philosophy and our behavior. And that ties into the value system. Again, it just creates this bigger perspective so that we're not whipped around with every little move in the market or every little change in our financial situation.
So yeah, I love that. And you explained it really well. I think existentialism is all about this idea that meaning is central to why we're here, and meaning doesn't always make itself evident. Like you have to go create your meaning. And even for people who are religious or spiritually minded, you've still got to go kind of figure out how that lives in your life and figure out how that informs the way you act. And, Martin Heidegger has this great quote. He was asked, someone asked him something to the effect of like, what can we do to live better lives? And he says, spend more time in graveyards. And, one of the most powerful experiences I've ever had was actually in the French catacombs, right? So you're under the streets of Paris, and the walls are literally lined with bones, right? The walls are literally lined with the skulls and bones of people who have gone before when the city was having flooding problems and needed to move them to a different place. But you get a sense of the impermanence of it all, and it really does put everything in perspective, right? I think the power of existentialism is putting this all in perspective. So many of us are out there working so hard, breathlessly kind of pursuing money and power and respect and all these things that all of us are sort of grinding for. And that's fine. Like, I mean, we need that, right? You need money to live. But I think existentialism gives us perspective to say, yeah, but in your pursuit of all this, don't forget that you can't take it with you, and you should spend some time defining these values, creating that personal meaning, and having that money further that meaning. So yeah, I think you did a great job of sort of breaking it down. And it is one of those sort of philosophical approaches. I feel like Stoicism and other philosophical approaches have been popularized by folks like Ryan Holiday, who've done a great job of sort of bringing this to the masses. I don't know that existentialism's been brought to the masses in a palatable way. So maybe that's a book that you and I can write together and do sort of existential money for dummies or something.
My sister is my biggest influence there. She's also on Instagram if people want to find her, but she is a clinical counselor, but getting her PhD in basically existentialism. And she has educated me so much on the topic and brought it to my attention, and just how it's actually kind of a beautiful thing.
Yes.
There was something you said that I really liked, which was about bringing perspective to the table. And I think that would be another great way to define financial wellness, is just bringing perspective to what you do with your money. I think that would be a great definition.
Yeah, absolutely. So Emilie, this has been fantastic. Before we let you go, we've got to do the lightning round, right? So the lightning round, we're going to talk all about a real passion of yours, which is around women in money. Okay. So I'm going to ask you 3 quick questions. You're on the therapist couch here. You just tell no filter. Just tell me the first thing that comes to your mind. You ready? All right. So the first question is, what is a common financial concern for women that men are largely oblivious to?
Values.
Ouch. But I think you're right. That one hurt a bit.
Sorry.
I don't think it's unfair. What is one practical step the industry can take to attract, retain, and promote more women?
Focus on retention first. The women you have, ask them what they need.
Wow. I love it. Yes, I love it. And then finally, all of the research suggests that in both retail and professional contexts, women investors outperform. What is it that makes women the ultimate behavioral investors?
I think they're so busy taking care of family and all the unpaid labor at home that they don't have time to look at the market every day. And so therefore they're not constantly reacting.
Oh my goodness, I love it. No time for nonsense. Too busy doing a meaningful work to tune in to every bit of noise. So Emilie, you've been fantastic. If people want to get a hold of this Instagram account that we've talked about, if they want to learn more about you, where can they go?
Well, thank you so much for having me. This has been a lot of fun for me. I am very active on Instagram, as you mentioned, and it's just my name. My handle is Emilie Hill. I'm sure you can spell that out in the show notes. But yeah, I'm very active over there. I love dialogue. So come say hi.
And that's Emilie, right? So Emilie, yep. Not with a Y, L-I-E.
The French way.
The French way, and then Dayyan Hill. Okay, yep. Perfect. Just want to make sure folks can find you. Emilie, you've been fantastic. Best of luck in getting this powerful message out to the people. We appreciate you so much.
Thank you so much.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.